This topic is very important for RBI DEPR examination. Listen carefully. Every year governments borrow trillions of rupees. But does borrowing make a country stronger or weaker? The answer depends on one simple question. What is the borrowed money being used for? Now, public debt refers to the total borrowing accumulated by the government over time. Governments borrow when their expenditure exceeds their revenue. The gap is known as fiscal deficit. To finance this deficit, government issue bonds and borrow from the financial market. Now, here's the most important point. Public debt is not automatically bad. Imagine the government borrows 1 lakh crore rupees to build highways, railways, ports, airports, even digital infrastructure. These projects improve productivity, create jobs, attract private investment, and support long-term economic growth. In such cases, debt acts as an investment in the future. However, problem arises when borrowing continuously finances consumption expenditure without creating productive assets. In that situation, debt keeps rising while future income does not. This creates a burden on future generation. Now let's understand one of the most important indicators, that is debt to GDP ratio. Economists do not judge debt by its absolute size. Instead, they compare it with the country's GDP. A growing economy can sustain higher debt because its income generating capacity is increasing. That is why debt sustainability matters more than debt size alone. Now think like a policymaker. During recession or crisis, government often increase borrowing intentionally. For example, COVID-19 pandemic, government worldwide expanded borrowing to support businesses, protect jobs, and even stimulate demand. This is known as counter-cyclical fiscal policy. But excessive debt also creates risk. High interest payments reduces funds available for development expenditure. Heavy government borrowing may push up the interest rates, making it costlier for private firms to borrow. This is called crowding out effect. Now think like RBI. Public debt influences bond yields, inflation expectation, interest rates, fiscal sustainability, and financial stability. That is why RBI closely monitors government borrowing patterns. Now here's where toppers stand out. They don't just define public debt, they explain debt sustainability, debt to GDP ratio, productive versus unproductive borrowing, crowding out, and growth implication. That is DEPR level understanding, because debt itself is not the problem. The real question is whether today's borrowing creates tomorrow's growth. Save this video for a quick revision and I'll see you tomorrow.